Mayuresh, very quickly, with regard to IT, what's your view?
Morning, Harsh. No, I think
Morning.
we're still absolutely neutral on the sector as a whole. Yes, I think the numbers were encouraging as far as TCS is concerned. HCL Tech more or less in line with estimates. The commentary for LTIM was pretty steady and strong as well. However, we still believe that with the global disruptions that are happening with the AI, the kind of capital allocation that is happening with the hyperscalers and the platform companies, the disruption globally might continue in a far fast-tracked manner than one probably thinks about. And therefore, I think the numbers might continue on a steady state basis that they have been delivering in constant currency revenue terms. EBIT margins might hold out. But when you're looking probably at the growth vectors, they still remain a little uncertain and probably a little bit of circumspect in terms of the dynamic growth that one probably sees. So even if valuations for large cap companies have become far more reasonable as we speak, I think all these factors put together make us believe that the sector probably still might consolidate, looking at both the global developments and their own balance sheet improvements as well. So absolutely neutral on the sector.
Mayuresh, in that case, is it better to look at the mid-cap, mid-tier IT companies rather than the large cap?
Morning, Sujit. So selectively, again, I think the companies have done well, right? You talk about Coforge or Persistent or LTIM, like the management commentary has been. But largely, I think our take is that you never really know. And I think that unknown component that probably still persists with the entire sector as a whole might pull down the sector if there is some element of adverse news which keeps on coming through, which we believe in terms of disruption, I think will continue over the next few months and quarters. And therefore, I think they'll have to rev up their game quite significantly. A few of these companies, Sajid, at the end of the day, might actually turn out to be outliers. And therefore, I think select mid-cap companies might outperform. But for the larger universe, as a construct for the sector, I think there are still ifs and buts as we speak.
Point taken. That's a contra view basis. Whatever we've been hearing of the consensus, and it's an interesting one. So, Mayuresh, I'll come straight back to you, but let me go across to Ashesha. Tata Elxsi, it delivered inline revenue, but both EBIT and profitability was sharply lower. L&T Tech also reported their numbers, but much more stable, right, in terms of the numbers, Ashesha?
Well, yes, L&T Tech was much more stable as compared to Tata Elxsi. First, let's talk about Tata Elxsi, where revenues were largely in line with what the street was working with, but margin performance was weaker this time around, and that is one of the reasons why the street could be disappointed with Tata Elxsi's numbers this time. Now, remember, this was the first ever quarter of 10 billion plus revenue that the company reported in the first quarter of FY27. Of course, FY26 was very challenging for Tata Elxsi, and after that, FY27 for Tata Elxsi has started on a fairly positive note as compared to the last year. Now, management remains positive on the media and communications business. They are very optimistic on the life sciences business as well, which will start generating revenue for the company in FY27. And we also have Nirmal Bang. They believe that there is limited margin improvement scope in FY27, which is why they continue to remain cautious on this counter. HDFC Securities, meanwhile, says that first quarter revenue growth of 1.3% for Tata Elxsi was largely in line. That's the constant currency growth in line with what the street was working with. But second quarter, we will see some bit of improvement in terms of wage hike, and that could perhaps weigh heavy on the margins for the company in the second quarter as well. So this time around, the performance on margin front was weak, and that is likely to continue going forward, and that could be a bit of a negative. Meanwhile, let's also talk about LTTS, and over here, as you mentioned, numbers were better as compared to Tata Elxsi because largely in line with what the street was working with. Revenue growth of about 1.5% on constant currency terms on a sequential basis was much better than what the street was working with. Nuvama has maintained its whole stance and they've hiked their target price. In fact, they've lowered their target price to 3,500 from 4,000 earlier. They're saying mobility growth was very strong this time around, and they believe ERD, that's the ENRD segment, is likely to report slow performance going forward as well, which is why they've lowered their target price to 3,500 from 4,000 earlier. MK meanwhile says that the operating performance was steady for this company. Revenue growth was better than expected, and they also said that they are seeing early benefits of favorable business mix, productivity initiatives and alignment with their 5-year Lakshya strategy. So yes, LTTA performance was largely steady across the board, but for Tata Elxsi, margin disappointment could be one trigger why the stock could be under pressure today.
Absolutely. Thank you so much for that, Ashesha. In fact, very quickly, I'll touch upon that margin point that Ashesha was making. 150 bips of margin headwind has come from one-off costs. Those should taper relatively quickly is what the management has said. Now, likely it'll take a quarter or two to unfold, but it'll compress fairly quickly is what they've indicated. 220 bips impact came from on-site delivery ramp-ups in the US, where revenue recognition has not happened, but the ramp-up in terms of employee costs has happened, which is why you've seen this large 370 odd basis point impact on margins just from these two pieces, right? This is EBIT margins that we're speaking about. But Mayuresh, you seem cautious with regard to IT. Just two quick arguments here. Fortune 500 companies, they rely on some of these large IT players, right? Very difficult for them to migrate to moving to AI without these players, right? So that could well play in favor of IT at some point of time. Second, how do you time this? When do you know that the bottom is made and this is when you go out and buy? When you start to realize that certainty is here, and if by then stock prices have run up, are you happier paying that higher price at that point of time?
Absolutely, Harsh, and that's exactly what we are trying to indicate here at Markets with India. I think even if we probably have to buy these stocks, say 8, 10, 12% higher, I think the element of risks probably reduces quite a lot. To answer your first question, I think a lot of the AI companies will need data sets that are absolutely clean. And our IT companies are working with a lot of Fortune 500 companies for long periodicities of time, and they absolutely know the business modeling. They absolutely know in terms of the strategization that has probably happened so far. And therefore, I think the dependence for a lot of these AI models will obviously have a pact with our IT outsourcing companies in terms of ensuring that they are able to access that clean data quite reasonably. The second element also is the deployment in terms of the application AI agents across the enterprise stack will also need a complete and holistic understanding of the entire system, which a large part of our IT companies have to a large extent in a few of their business segments and some business segments completely as we speak. And therefore, I think when you're talking about pacts being signed in terms of ensuring that AI platforms, hyperscalers probably get access to clean data, as well as application of their enterprise stack models actually coming through in collaboration with our companies as well. I think that is very much a reality. Now, when, how does that happen is a big question mark. And therefore, that's what I said. I think there are a lot of ifs and buts to this entire argument. Once we see things moving in the right direction, and even if the price action is on the higher side, there is no harm in probably getting into those stocks. So we'll change our stance accordingly. But that if and but over the next 1, 2, 3 quarters and the uncertainty thereof is making our neutral stance. If this happens, I think we'll change our stance as we speak.
You know, the other set of stocks which will be in focus are the textile names, Mayuresh. Now, I mean, we've seen a decent run-up in these stock prices. Still a buy, you reckon? This India-UK FTA and all of the other things that's playing out, the CETA, the India-US treaty, which is benefiting them. Do you believe that the cycle is in the early stages of turning or pretty much priced in?
So no, I think there are a lot of positives that one can probably take out of the entire UK FTA agreement, as well as the European agreement that will come through. I think two things happen. One, I think in terms of price parity, as far as our taxation was concerned, compared to Bangladesh, compared to Vietnam, compared to Pakistan, that probably comes at par. And therefore, if you probably look at the construct in terms of our exports, whether it's cotton pillows, whether it's bed sheets, whether it's cotton cases. I think India had a reasonable share, but I think we were losing out in some parts to our neighbors and counterparts. Now, with this parity probably coming through, I think there is a level playing field that probably happens. And therefore, I think a lot of our players, including the likes of a Vardhaman as an example, including the likes of an SP Apparon or a KPR Mill, which have got integrated operations right from yarn till fiber, I think they get benefited across the cycle because you've probably seen with lesser rainfall, Harsh, that cotton prices or kapas, as we call it, are showing signs of volatility. And therefore, I think the integrated operations will obviously abet these players to a large extent to manage volatility in terms of margins. And as the export opportunities probably open up, the kind of volume growth, utilization levels that probably happen will ensure that the margin absorption in terms of fixed costs are probably taken care of, which might lead to better realizations and better leverage onto the P&L. So yeah, I think integrated players within the textile space can probably do well. Obviously, I think the results will not be seen over the next couple of quarters. You'll have to wait it out. But I think second quarter onwards, as the normalization probably happens, you will see gradual ramp up happening. So I think FY27, FY28 numbers for these integrated players might be relatively better as we speak.
Mayuresh, while I agree that there's an opportunity for textile companies, are we going to see immediate impact on the numbers for them? Because this is a gradual ramp up that may happen, and you're assuming that the competitors which are there for Indian textiles, whether it's in Bangladesh or other Southeast Asian countries, will not be reacting to it.
No, obviously they react. It's a competitive industry, right, Sajid? And that's what I just said in my remarks. I think it's not going to be immediate. I think once the agreement probably comes through the next couple of quarters, you'll still see revenues which are not having a huge ramp up. As the ramp up probably happens over the next few quarters, exit 27, exit 28 numbers should be relatively better. Again, I think from an industry construct perspective, I think why we're preferring and why we believe that the integrated players might do well is because of both the dual reasons, right? They can manage the volatility in terms of input costs as far as supply is concerned. And as far as demand dynamics and competition is concerned, I think they will be pricing it well to ensure that they garner market share initially. So I think the next few quarters will be a gradual ramp up, but as things improve and they start gaining market share, I think that will obviously reflect better in terms of volumes, realization, and the leverage on their P&L.
Okay, just looking at the market texture yesterday and, talk about some buzzers. While, of course, the pain point yesterday turned out to be IT, just want to see what was actually holding out. And there were some dots of green, while overall the market breadth did fall through in trade yesterday. But Biocon, that big surge after the Mylan exit and the block deal that transpired in the morning, almost about a 6% notch up on that stock. Some of the Adani names like Adani Power, Adani Green held out very well. MCX was a buzzer. It shot up about almost 4% in trade. And Concor, which was higher by about 6% or so. Kunal, on the charts for Concor and Biocon, what do you foresee next?
Yeah, I think Biocon is interesting over here, Aisha, because Biocon, I think, yesterday managed to come back in towards a retest of the previous resistance, 435, 440 band for Biocon. But more importantly, the indicators are starting to show signs of a breakout. Now, we've seen many a times that when weekly or monthly indicators, when they come back into a breakout mode prior to the prices breaking out, that's generally a precursor move or an indicator that the prices are likely to come back into a decent uptrending mode. Yesterday's move, of course, was met with high delivery data for Biocon. The stock, gave a very strong candlestick up move. The gap was also seen into the stock prices. And many a times, these kind of gaps, if remains unfilled, then we expect that the prices come back into a very strong uptrend. So I think the chips are now in favor for Biocon to at least come back into a trending mode. And if that happens, I don't expect this to be a very minor kind of an uptrend for Biocon, but maybe it could be a magnitude of at least 15 to 20% further in the very short span of time. So I think 440 is the breakout point which I'm watching for. If the stock closes above those levels, it could be a strong buy. Concor, on the other hand, the stock has come back towards a recovery. I was looking at the charts for Concor. Even after this 5-6% up move, the stock has come back very marginally around its 200-day moving average. It's way off from its 2024 highs, but at least on the short-term charts, it looks like that maybe the short-term aspect for the trend could come back into a mild recovery. 485, 500 has been a huge hurdle point for Concor. hopefully this time around the stock may be able to cross above those levels.
Look out for KEC International as well in trade today. They won about 1,180 crore rupees worth of T&D orders. So that stock may actually react to it. But Mayuresh, morning firstly, wanted your sense in on what is it that you like for a buy or add at these levels from within the power transmission and infrastructure EPC space?
Morning, Aisha. I think it's very interesting, right? And as a space structurally, I think there are a lot many drivers taking place. I think the entire transmission sector as a whole will attract a significant amount of investments, both globally and in the Indian context as well. In fact, just the grid capacity is expected to go up from 148 gigawatts right up to 168 gigawatts. And the number of transmission lines are expected to get added on to the tune of 150 circuit kilometers. And so are transformers, etc. So I think the entire power value chain is expected to do well. I think within this space, I think a recent addition that we've done in our portfolios is Skipper. Our own sense is that they have posted record revenues as far as FY26 was concerned, 5,500 crores, if I'm not mistaken. They've got a record order book as we speak of 8,800 odd crores. There has been a decent EBITDA margin improvement at 10.4% from 9.8%. And the leverage is obviously getting played out in terms of return ratios, specifically ROEs, which are improving quite significantly as we speak. So our own sense is that as the engineering part of the business and as Power Grid will ramp up its capex, where the expectation is that the capex should probably go up to 45,000, 50,000 odd crores in the coming financial year. A large part of those orders should probably come through in terms of the HVDC and the UHV lines, which is 765, 1100 or 1200 kilowatts. And therefore, I think, in our opinion, I think the engineering part of the business should hold up for Skipper. KEC should also equally do well, in my opinion. But I think this space, very, very interesting. I think a few of these stocks are actionable in our model portfolios.
Right, okay, that's that on KEC International and the entire power transmission and infra EPC space. In fact, we're going to be chatting with the KEC International management as well today. Vimal Kejriwal will join in at 9:45 a.m. in due course of the show. But Signature Global, that's the other one which is in focus on the back of weak earnings for the June quarter. In fact, the company sold less units, denting its pre-sales as well. Rabinda is here with details on their sales.
Well, as Signature Global reported a weak Q1 FY27 operational update, and in Q1 FY27, company's pre-sale declined to 25.4% on a yearly basis to rupees 1970 crore from 2,640 crore, and while collections also fell to 28% on a yearly basis to 670 crore. And if we compare this pre-sales and collection with the company's FY27 guidance, then against its FY27 guidance of 10,000 crore in pre-sales and 5,000 crore in collection, the company has achieved 19.7% and 13.4% respectively in Q1 of FY27, and the decline in pre-sales was mainly due to sharp fall in units sold, which dropped to 71% on a yearly basis to 226 units as compared to 778 units in Q1 of FY27, although sales realization has increased to 5% on a yearly basis to 17,093 per square feet, and the performance was also impacted by a high base as Q1 FY26 includes several large and successful project launches. And on the positive side, the company has said that they have entered the branded residence segment through Tonino Lamborghini Residence in collaboration with the Italian luxury brand. And management said the first phase of the project on Southern Peripheral Road, Sector 71 Gurugram, has received a stronger market response. But overall, it was a weak operational update in Q1 FY27 for the Signature Global. So back of this, the Signature Global can be in focus in today's session.
Yeah, that's Signature Global in focus after a weak set of numbers. Let's also welcome on board Saumil Mehta and ask him about what he's making of the market setup right now. Saumil, hi, morning. Great to have you in the show. IT, the big casualty yesterday, but overall as well, you had many sectors, Saumil, which gave way yesterday. And while we did just about manage to defend 24,000 in the Nifty futures, today seems like a lot more stable start. What levels are you monitoring on the index now?
Good morning to everyone. See, at this point of time, markets have been a little range bound. The positive part at right now is that markets have taken support at 23,000, which was a 61% retracement of the previous rally. So that's a very positive sign because respecting crucial levels and going forward, making higher top, higher bottom formations on daily charts, on weekly, monthly charts, that's a positive sign for the markets. Now, there is a hurdle around 200 daily exponential moving average where we took resistance and started making a little bit of correction. Now, the range is a little broad between 23,780 and on the higher side around 23,300, 23,500, and 200 daily exponential moving average is 24,400. So that 300 points range on the upside is a very, very crucial resistance for the markets and probably would take some time for Nifty to break above this range. Now, overall, the bias remains sideways to little cautious. The reason is that crude has jumped up to 85, 87 levels. Rupee has depreciated till 96, 96.20, the last tick I saw. So these are some concerns which I'm looking at, and because of that, the IVs have jumped up as well yesterday. So these are some points which are a little concerning at this point of time. So the support right now on the downside is 23,950 and 23,780. So these are some levels. I'm not expecting markets to, break out either side at this point of time. I'm just expecting a range bound movement, and there will be opportunities in a lot of sectors. As we saw, yesterday in pharma, there were a lot of stocks which broke out and gave us a new rally on the upside.
Interesting. I'll come to pharma in just a minute, Saumil. Mayuresh, let me quickly quiz you with regard to the China factor. GDP coming in at 4.3% versus the expected 4.6%. Likely negative metals in your opinion, and if so, how material? Would you be concerned if you're a holder? Give us a sense.
I think the China trade was there a few months back, but now again I think the market is consolidating as far as China is concerned. So whenever we speak to our colleagues who are based out of China, I think their take is that it's going to be a very, very slow and gradual recovery as we speak, because discretionary spending is not come back completely as far as mainland China is concerned, and therefore I think the print in terms of macro factor, which has always been circumspect, might still continue to be a little bit calibrated as we speak. Therefore, I think when you probably look at MSCI and you look at MSCI ex-China, I think India has clearly been lagging because of the lack of AI trade. But again, I think if earnings come back at some point of time in the second half, and hopefully I think this escalation does not last longer, I think the FI return might be pretty strong as far as the Indian context is concerned. So China, very slow and calibrated recovery as far as our colleagues have probably responded to the economic recovery.
And Mayuresh, also curious to know, is there a view on real estate that you have, given the fact that we've seen a sharp unwind, right, in terms of the discount at which valuations were at. We've seen a very sharp unwind, and now we're seeing a reversal of that unwind to a certain extent. How is it a good time to even enter even now, or would you wait and watch?
No, so I think one of the best trades in real estate, and the only one that we had, was Phoenix Mills, and the stock has run up quite significantly high. So I think it's not a prudent trade at this juncture. Obviously, we met our targets as far as Phoenix Mills is concerned. But I think the outlook that Phoenix has probably given is very, very encouraging on the retail space, from 11.5 million square feet to 14 million square feet exit 28, 18 million square feet exit FY30. The offices space is expected to compound quite significantly as well. The hotel keys are expected to have a significant additions from 588 keys right up to 2,188 keys as we speak. And residential is doing well. So I think the cash flows that they're probably generating, Harsh, and then the EBITDA that they're probably generating at a consolidated level is pretty strong. So the OCF to EBITDA still remains about that 100% mark. The margins remain relatively strong. The fit outs and the expectations in terms of releases that probably are expected to come through in FY27, in FY28 seems to be on a strong footing as well. And therefore, the mix that Phoenix probably has, retail, office, hotels, residential, I think we like what they're probably doing. And it probably reduces the risk propensity in terms of catering to one business segment.
Any ideas, Mayuresh, that you can leave our viewers with? I know I need to let you go. So any ideas, stock ideas, sector ideas?
So engineering is something that we continue liking, as I said, and therefore I think Skipper is one that probably comes through in terms of the entire power ancillary space. Newland Labs within the pharma space is something that we continue liking. Our own sense is that the numbers specifically on the CSM front might continue remaining very strong and robust. They've got a pipeline of almost 98 odd drugs in phase 1, phase 2, phase 3. So at some point of time, as the criticality probably progresses and approvals start coming through, the high margin profile that the company probably posts and is expected to continue might continue in terms of their balance sheet strength. And therefore, I think return ratios, cash flows, the rating and rankings that we see in markets with India look extremely strong and robust. So I think domestic engineering and a little bit of pharma is something that we have as actionable as far as the model portfolio is concerned. Clear disclaimer, Harsh, these stocks are a part of our portfolio. Clients might be having it. I don't have any personal.
Right. Okay, Mayuresh, great to have you on the show. Thanks as always for your time. Just